Everybody, welcome to HAMB's Wednesday webinar with Freedom Mortgage. And we are here today with Kelly Dunbar. And we can see that a number of people are starting to join. So we'll just give it a couple of minutes while everyone starts to join before we begin here. And Kelly, I want to talk about the NAM conference. So remember, for everyone on HAMB, your HAMB membership, Hawaii Association of Mortgage Brokers, is inclusive of your National Association of Mortgage Brokers membership. It's already included in your membership, so there's no additional fee to pay or anything like that. And in the same way that HAMB has their events and educational events and conferences, NAM has their conferences and their educational events as well. And last month was the national conference in Las Vegas, which a number of us were really lucky to be able to attend. And I saw Kelly there. It was a blast. And Freedom Mortgage put on quite the big show. And we were able to go see Pink live in a private event. So Pink, the singer, the artist, in a private event, screaming Freedom Mortgage's name at the top of her lungs in a microphone. So very cool. Tell us all about it, Kelly.
It was really fun. I'll start with the NAM convention itself. The attendance was so good. It felt very energized. Lots of vendors, lenders, tons of loan officers. I thought the speakers throughout the weekend were really excellent, really good topics. It felt, we've been through kind of a lull in the mortgage industry, and it felt like a coming out party, honestly. It felt like everybody was back and energized and ready to do business and finding good partners. And so the conference itself was just fantastic. And then we were fortunate, so NAM actually backed up to the MBA this year, which is the Mortgage Bankers Association. So NAM is the National Association of Mortgage Brokers, and then there's the bankers. And so since it was back to back, Freedom took the opportunity to host a concert for all of our clients, and Pink was the artist that we were able to have. And it was such a cool event. It was at the new Resorts World Casino, which I hadn't been to before, and what a beautiful space they had there for us. But it was really a lot of fun. It was a great concert and a really fun event, and got to see so many people we haven't seen in years, and then people we saw the day before. So it was really a lot of fun.
Oh, it really was a lot of fun. And I agree with you 100%. It was really just so energetic at this conference this year. It really felt like the mortgage industry was back. Everyone was riled up. We were ready to have a great few years. You could tell the energy that 2025 has definitely been very different from 2024. People are out there, they're having fun. They're really enjoying the mortgage industry again. Lenders really reaching out to those brokers to, bring them in and rev up that energy. So it was just so awesome to be there. I haven't been to the NAM conference in a while. So that was a great coming out for me as well. And to see everyone there having such a great time with that energy was amazing.
I'm sure it was a lot of fun. And it was really kind of cool too, because there's definitely some crossover, between the mortgage brokers and the mortgage bankers. So it was nice to have it, but it was a lot. It's a lot of time to spend in Vegas. 4 nights is a lot. But it was really nice to have them back to back, because there's people you don't normally get to see that there is crossover that you do work with. And so that was really a good opportunity as well.
Exactly, 100%. All right, you guys, it is 10:04. Looks like we've got a bunch of folks that have joined. So we'll go ahead and get the webinar started. So again, welcome everyone to HAMB's educational webinar today featuring Freedom Mortgage and Kelly Dunbar. Before we get started, let's talk a little bit about our sponsors who make everything possible at HAMB. First off, Freedom Mortgage. Thanks for being here today, Kelly. Platinum sponsor, The Loan Store, New Res, DeKind Lending, PennyMac, LendSure, and Deep Haven. Gold sponsors, we've got Finance Factors, Title Guarantee, Advantage Credit, Remin, Angel Oak, Accra Lending, Foundation Mortgage, and Home Express. And of course, our silver sponsors, Open Mortgage Wholesale, Sierra Pacific Wholesale, Cardinal Financial, Logan Finance, and ARC Home. Thank you all to our sponsors for making HAMB so great and so wonderful to be a part of. Thank you so much for your sponsorship. For the upcoming events, we have got a bunch of stuff happening. So remember, tomorrow is the Pauhana Lenders Roundtable at Anaha in Ward Village. So if you have not already signed up, please do so right after this webinar. We'd love to see you. Our theme is Taco Thursday, and we've got street tacos for you. We've got taquitos. We've got free drinks, and then of course that gorgeous view off of the top of Anaha. So it's going to be amazing, and of course with it happening over sunset, it's just not to be missed. So make sure that you get your tickets today. And then at the end of the month, November 19, we've got Get to Know PennyMac. So make sure that you are joining that event as well. Our holiday party coming up for HAMB is going to be December 4. Make sure you're checking the website to see exactly what our location is going to be. We are still choosing the venue, but it's going to be a great time holiday party with new board installations. So please make sure to join us. Go over to hamb.org. That's HAMB.org. Just click on the events tab and then go ahead and sign up for the events. We'd love to see you, and we are looking forward to it. And without further ado, Kelly, go ahead and take it away, Freedom Mortgage and your VA.
Sounds good. I told Judy she didn't have to introduce me because I would do it myself. I can figure out how to do this. And I used, it was chatting with ChatGPT about where, see, it's, is it showing up? It says it's thinking. To come up with my introduction. So it's a little bit fun.
Perfect. I can see it now.
Judy, can you see my screen now?
Yep, we can see your screen.
Perfect. Great. Okay, so I did a quick about me, sponsored by ChatGPT. First, on the you'll notice on the left of the pictures, you may notice there a few friendly faces. You've got Judy Meredith, my HAMB education co-chair. And also you may recognize there Naki Wilson from Accra, who's one of our HAMB sponsors, but this was at the Pink concert in Las Vegas, and I thought that'd be fun to include. So about me, I'm a mortgage nerd with a heart. I love making complex guidelines feel simple and human, fueled by coffee, chaos, and two amazing kiddos who keep me laughing and humble because they're embarrassed of every single thing I do right now. Equal parts logic and empathy, obsessed with numbers as I am with people, happiest near the beach, on a tennis court, or enjoying a concert with friends, as you can see. And my favorite compliment, you make this whole process feel easy. So let's get into it. Let's just chat really quickly. Why Freedom Mortgage? It's underwriting made simple. We have almost no overlays. We are strictly agency and government lender. We have no DSCR, no seconds, no jumbo. So we focus on, we do really, really well. So our kind of special sauce is to price really aggressively with almost no overlays. We have an easy, intuitive wholesale portal. We have simple LE with smart fees to make it as quick and easy as possible. We accept transferred appraisals and also temporary buy downs available. Other ways we help you shine, we have a free 7-day lock extension on all purchases. It is regardless of market condition at any point during the transaction. You have to request it. It doesn't automatically apply, but as soon as you request it, it's added. We also offer 2 5-day free lock extensions on all refis if the market is the same or better as when you originally locked. Condo questionnaires, we order and pay for those for your borrower. That is both purchases and refis. I know oftentimes sellers pay for those in a purchase transaction, but if you can get with your agents and tell them that you can use that as a bargaining chip, well, your seller doesn't have to pay for the questionnaire because Freedom will. Credit reports with score improvement. So if you are working on improving your borrower's credit score during the process, you can update that credit report with an updated score at any point during the process, and we will apply the new improved pricing with that improved score. Also, odd loan terms are available. We do super odd. Any year, any number of months, we can cater your loan term if your borrower is interested. You call, we answer. So I like to think that Freedom is a good mix of, it's good technology, but we're really driven by people. So we are always available every step of the way. Every person who works on your loan is available to you: underwriter, registration, account manager, myself. I have an assistant. We're always here available to help. And we do offer overnight price protection. We won't get into that now, but if you have any questions, you can give me a call about it. All right, so what I want to talk about today, the two main things I want to talk about are ARMs and IRRRLs, which just seems to be what the conversation in the market right now we're talking about the most. So let's talk about ARMs. It's been a while since we've been in an ARM market, so let's just go over some basics and what you need to understand, and of course any questions we can get into later. So when are ARMs used? Typically in high rate environments, when we expect rates to decrease in somewhat in the near future, to help qualify borrowers using lower monthly payments. So on government ARMs, we use the note rate for the qualifying rate. So you are able to use that ARM rate to qualify your borrower. So that kind of leads into the next point, which is enabling qualification for larger loan amounts. Lower interest rates means more loan the borrower can qualify for. Free up cash flow for home improvements. You've got those lower payments, refi opportunity to lower rates. So now when you're looking to maybe do a debt consolidation for somebody, maybe you're actually able to get them into an ARM to a much more reasonable refi rate than what a 30-year fix would look like. Faster equity building, the lower the interest rate, quicker we pay down equity, or I should say principal. And IRRRLs, I do want to talk about this because one of the great things I'm seeing right now is we're using ARMs for purchases. So let's talk specifically about VA for a minute. We kind of all have this underlying feeling that we may be going into an IRRRL market in somewhat the near future. No one has that crystal ball as to when. But if you're putting your borrower in now, your net tangible benefit is met immediately when you IRRRL from an ARM to a fixed. So your opportunity to IRRRL your borrowers is going to be one step easier when you put them in an ARM. So thinking down the road, if they're nervous about that rate adjusting, you can have the conversation about an IRRRL down the road. Now, we'll talk a little bit more about what that process looks like when you're going from an ARM to a fixed or from a fixed to an ARM when we get into the IRRRLs, but I did want to mention it here because when you're having those initial conversations about getting into an ARM now, it's worthwhile to think into the future. So some of the basics, ARM components. We have the initial rate. That's the starting interest rate of the loan. So let's say it's 4.5% on a 5/1 ARM. The index, which is the benchmark rate that changes regularly that determines the interest rate. So the FHA and VA ARMs are based on I should say there are different ones, are based on the constant maturity treasury. Margin is the fixed percentage added to the index. I'm sorry, it looks like a typo there. Sorry about that. Fully indexed rate is the potential rate once the fixed period ends, and it's calculated by adding the margin to the index. So I have a little visual here just to make it simple. So ARM rates are calculated by adding the index plus the margin to get the fully indexed rate. So to kind of give an example, if the CMT index is at 3.25%, I put a little asterisk there because I put the actual data down here at the bottom, but let's just go with the example here for a minute. And the margin is 2.25, which it is on all of our government ARMs. Then the fully indexed rate is, oh, there's another typo. Sorry, I was going in and messing with these numbers earlier. Would be 5.5%. So below it, I put the chart as of this week. So this was, I pulled it as of November 4th with a 1-year CMT. This week is at 3.61. A month ago is at 3.66. A year ago is at 4.03. So it kind of gives you an idea of gauging what the volatility looks like. Sometimes the past can predict the future. Understanding ARM program names. So again, this is just because we haven't done ARMs in a while, it's worthy of a refresher. The initial cap limits the interest rate of the first adjustment. So the cap on our government ARMs is 1%. The periodic cap limits the rate change on the subsequent adjustments, which is also 1% for our government ARMs. Lifetime cap, the highest rate that can be charged over the term is 5%. So that's going to be, and then the floor is the lowest rate that can be charged over the loan term, which is the margin, which is 2.25%. So a 5-1 ARM with a 1-1-5 cap structure, which is what ours look like. The initial fixed period is for 5 years. The adjustment period is how often the rate can change annually after the initial period. The initial cap rate can increase by 1 point. Periodic cap, I should say. Rate can adjust by 1 point in subsequent adjustments. And the lifetime cap rate cannot increase more than 5 points over the loan term. So again, sometimes a visual is a little bit easier to see. Our products. So we do offer 3-1 and 5-1, both conforming and jumbo on VA and FHA. I lined through the 3-1s here because right now they don't make any sense. They are pricing worse than the 5-1, so clearly you wouldn't want a shorter ARM period for a higher price. To give you kind of an idea of where these are pricing, typically, I'll be honest with you, you're going to want to go borrower paid with ARMs. The margin for lender paid credit is smaller on these, so you're going to see substantial movement in rate for very little difference in over par pricing. So it makes sense to go borrower paid on these. Typically, you're beating your borrower and you're kind of setting yourself for a refi down the road. I'll mention here too that we actually already have. We introduced conventional ARMs this week. Right now, we're not very aggressively priced on them. We're getting them into the system, tested, run, on the rate sheets, all those things. We intend to be very aggressively priced on those. So we will be talking about those in the coming weeks and months. At the moment, they're just kind of in test mode. They're rolling everywhere. Again, our intention is to be very aggressively priced on those as well. So let's talk a bit about IRRRLs. So I did run through that ARM stuff fast. Again, if you have any questions, feel free to reach out at the end of this presentation or offline. I'm happy to discuss more about that. Understanding IRRRLs. It's been a while since we've been in an IRRRL market, so it's definitely worth a refresher. So let's chat first about net tangible benefit and recoup. So the net tangible benefit has to be one of the two following. When you're doing a fixed to fixed IRRRL, you need to reduce the interest rate by at least a half. When you're going from a fixed to adjustable rate transaction, you need to reduce the interest rate by 2%. That seems wild. I have closed several of these where they were going from fixed to ARM. You do have to lower it by 2%, but we're starting to be in a market where we're going to be seeing that and closing those. I did leave off the third bullet point, I apologize, which is going from an adjustable rate to a fixed. And that is because the net tangible benefit is met immediately. There is no additional net tangible benefit when you're going from an ARM to a fixed, but it would be nice to have a bullet point there stating that. So we just talked about net tangible benefit. Let's talk about recoup. So that's the length of time it takes to pay off any closing costs and fees associated with the transaction. So let's talk a little bit more about that. So recoup is required anytime you are lowering the P&I payment and the recoup period of fees is 36 months or less. So those closing costs are going to be any fees, closing costs, basically any costs associated with the loan other than the funding fee, the prepaid interest, and the escrows. Those are not included in your recoup calculation. Everything else is, and you just need to, the monthly savings of your new PITIA payment has to, the monthly savings, why am I having a strong saying this? You have to make it up within 36 months. So let's say your total closing costs were $5,000. In 36 months, you would have to, if you were saving $100 a month for the next 36 months, you wouldn't meet it, right? So you would be less. So you want to make sure that your recoup meets that cost. Now, if you're in the same situation, your total closing costs are $3,600, you're saving $100 a month, then you're meeting your 36-month recoup. Now, if the transaction results in the same or higher P&I payment, and you're asking yourself, why would anyone IRRRL into a higher payment? And this is what we were talking about before. Let's say you're going from an ARM to a fixed. So you're going from 4.25% interest rate, and now you're going to, let's just say, a 5.5% 30-year fixed. It makes sense for the veteran. Certainly, we know the net tangible benefit is met because we're going from an ARM to a fixed. but the P&I payment is going up because the interest rate is going up. If that is the case, then the veteran can incur no fees, closing costs, or expenses. Again, that doesn't include the funding fee, prepaids, and escrows. Those costs can be incurred. But essentially, you need enough over par pricing to make this a no-cost loan for the borrower. So that's the one thing you want to look out for when your net tangible benefit is met when you go from an ARM to a fixed, but you do still have to meet recoup. Eligibility requirements. So we have our famous 210 days from the first payment due date on the note to the closing date of the new mortgage. And anytime you hear the term closing date with VA, closing date means signing date. So the 210 days is from, let's say, March 1st, 2025 would be the new signing date. With 210 days away, you could sign loan docs, you'll have your right of rescission and fund thereafter. VA does require 6 consecutive on-time monthly payments made anytime during the existing mortgage. So at any point in time while they've had that existing VA mortgage, they must have made 6 consecutive on-time payments. So we'll chat a little bit more on this next slide. So ultimately what that's saying is you can have 30-day lates, 60-day lates, 90-day lates. That is not going to affect your eligibility for an IRRRL. So long as you have a 6-month window of on-time payments and the mortgage is current at closing. It cannot be in default. It cannot be behind in payments, or property taxes for that matter, or insurance. It must be current at time of closing. Otherwise, payment history, we're not paying any attention to it. As far as credit scores go, we have a minimum 580 credit score unless it is a freedom to freedom transaction, in which case we will go down to a 550. Remind me to tell you, this I didn't want to put in great detail yet, but we have verbal approval. So right now we are allowing, and you'll see it on the next slide, we're allowing a single bureau soft pull credit score. So ultimately soft pull, which is nice, then single bureau, meaning you can choose whichever bureau is the highest and send it to us. What we have a verbal approval on, but not yet because it takes some time just to update systems and guidelines and all that good stuff, is that we will allow the higher of 2 borrowers or 3 borrowers, however many borrowers you have on your IRRRL, we will allow that to be the determining score, so long as all borrowers have a 580 or higher. So if you have one borrower who has a 700 FICO and the spouse has a 620 FICO, and you're just using the single bureau soft pulls, we can use the spouse with the 700 FICO for pricing purposes. So that is also another advantage that will be updated in guidelines in the system, but right now it's a manual process, but no problem, easy peasy, we have full approval. Let me know if that's the case and we can help you with those. Borrower's eligibility, they must be on the existing mortgage in most cases. I'll tell you the easiest exceptions to just go over quickly. There are a few more, but generally speaking, only time borrowers can change on an IRRRL are in case of death, divorce, or marriage. So there are 2 borrowers on the loan, and now it's only going to be veteran in case of death or divorce. That is allowed. Or if veteran marries, wants to put spouse on loan and IRRRL, that is also allowed. There are a few other examples, other scenarios where borrowers can change, but that's going to cover the bulk of it. Veteran must own the property, and the other thing that when it is allowed is surviving spouse. The veteran is allowed to IRRRL as well. Occupancy, they are allowed on primary residence, second home, and investment property are all allowed on IRRRLs. As long as that mortgage is still held by VA, they are eligible for IRRRL. I should mention there is a price difference if it's not a primary residence, so you want to pay attention to that, but it is absolutely allowed. Amortization, like I mentioned earlier, odd terms are allowed. If you have a borrower who says, okay, but I've been paying down on this thing for 4 years and 7 months, and I don't want to add any more to that balance, easy peasy. We can do that, no problem, no price change, very simple. If you are doing an ARM, the only terms we allow for those are 30-year terms. the max loan term, this doesn't come up too often, but it does sometimes. The max term allowed on an IRRRL is the original term of the existing loan plus 10 years, but not to exceed 30. So obviously we don't do more than a 30-year term. It doesn't, like I said, it doesn't come up very often, but something to mention. Minimum loan amount, I don't know why it said minimum loan amount is the existing unpaid principal balance. That is not true. If you have a borrower that wants to make a large principal pay down during an IRRRL, what better time to do it? Because government loans won't recast, your borrower can make a large principal payment, but their monthly payment will stay the same. If they want to lower their monthly payment by making a large principal pay down, I'll be honest, an IRRRL is the ideal time to do it. If you're doing it as a cash out, you're back to qualifying, full doc, you have an appraisal, you have a higher funding fee. With IRRRL, it's very simple. If they want to pay down their loan and quote unquote recast the payment, it's a perfect time to do it. There is a max loan amount calculation, and that is the existing loan's outstanding principal balance plus the current interest due. Again, we already mentioned this earlier, but the new loan may not include delinquent interest on the old loan. It does have to be current. All eligible closing costs can be financed into that max loan amount, plus the VA funding fee, which is 0.5% for IRRRLs. So that is the calculation to figure out the max loan amount. I didn't say it here, but borrowers can get up to $500 cash back in that transaction as well. Underwriting requirements, so simple. I didn't go over the credit qualifying IRRRL. It doesn't happen very often, and that would be, let's say you wanted to remove a borrower that in a situation that wasn't allowed or something along those lines. So we do them. They're absolutely available. They're just very rare, so I didn't feel like it was worth a slide. So we'll just chat about the non-credit qualifying documentation. 1003 with no income listed. In fact, we don't even want you to list the employer. Please don't. Just leave the employment and income section completely blank. Same with assets. It's going to be a very limited 1003, and that's what we prefer. Again, we will allow a soft pull, single bureau credit report, which is nice. We need the note or current mortgage statement plus the current payoff, VA case number assignment, certificate of eligibility, loan comparison statement, title commitment, homeowner's policy. That is it. That is everything that you need for an IRRRL to get that thing closed. Obviously, you have to meet net tangible benefit and recoup, but as far as documentation goes, that is all you need. So some of the perks, we mentioned the 5-day lock extension if the market's the same or better. We've also talked about the soft pull single bureau credit report. We can net escrows on freedom to freedom refinances, which is always very nice. Borrowers really love that. And there is no appraisal or AVM required ever, regardless of loan amount, regardless of FICO, regardless of LTV. We don't even calculate LTV. There is never any point in time an appraisal or AVM required. And that's about it. This is my contact information, which hopefully most of you already have. If not, I'm happy to share. And then let's get back to seeing Judy's smiling face. Let's see here if I can figure it out, the technology.
Hi. Thank you so much, Kelly. I know that we agreed that you would introduce yourself, but you are one of my dearest friends, and of course, just a wealth of knowledge when it comes to all things government, as well as conventional, but mostly government, and of course the VA. Everything that you mentioned today in this webinar really jazzed me. You know, you and I just recently closed a IRRRL together, and yeah, you know, even though we used to do a ton of IRRRLs in the past, it's great to have a refresher, because when you haven't done something in a while, it's just like riding a bike. Yes, you can ride the bike, but you fall off a couple of times before you start doing it in a steady fashion. So what a great refresher. I loved that you mentioned about having the granting the ARM on the first go around, because then the net tangible benefit is met. With the added layers of requirements when it comes to IRRRL, you know, compared to how it used to be prior to some of the legislation coming down. Sometimes it can be tough, you know, to meet the net benefit, the interest rate reduction, plus the recoupment costs and the requirements there with the 36 months. So to have that net tangible benefit met automatically is really a great strategy, and it does set you up for that next loan, which is fantastic. and such great intel. So for everyone on the call, the chat box is open. So please, let's have your questions come in. Kelly and I will chat just a little bit while we're waiting for your questions to come in, but chat box is open. Questions, please bring them in. The other thing that I heard you mention is the bringing in the large principal down payment or principal contribution during the IRRRL process to reduce the loan amount. I think that that's something that a lot of folks don't think about and don't offer during the IRRRL process. So I think that that was a great idea as well. And then just a refresher that the 1003, no income, no assets. I think a lot of us still struggle with that. Do we put the employment in, but we don't put the income? Do we need one LES? You know, what do we actually need? So just a reminder of the blankness of the application is makes it much easier and takes away some of that the scariness of putting the application together.
It really does. You'll even run into like an error message hard stop if you put in an employer, then it wants you to put in an income amount. We don't want either. We don't even want to do a VOE. We don't need to know anything. We are simply going, we have zero overlays here. We're going bare bones of all VA requires, and that's what we're doing.
Awesome. And I think a good thing to mention also is that even though the veteran has turned that property into an investment property and they're no longer living there as owner occupied, that they're still eligible for their IRRRL. And even if they've left the military and they're in a different job or they've retired altogether, that they're still eligible for that IRRRL.
And IRRRL can also be a good time, like I mentioned, for a large principal pay down. It can also be a good time to remove a borrower from a loan. And I'll tell you the one I run into the most often is that two service members buy a property together, which makes sense. They're young, they're single, they buy a property together. Well, now one of them wants to buy the other one out. But if you do a cash out refi, once again, you're back at probably your 3.3% cash out subsequent use funding fee. It's prohibitive. So if you can do a credit qualifying IRRRL, I mean, obviously the rates have to work in your favor a bit, but that is also a good opportunity. I really am surprised the number of times I do a credit qualifying IRRRL to remove somebody from an existing VA loan because it's substantially easier.
Absolutely, 100%. So let's dig into that a little bit because we have had some instances like that come forward, and even during a divorce setting, right? Mm-hmm. Where now we are removing the spouse, but we did use them to qualify the first time around. So in that situation, would we be using the credit qualifying IRRRL as well?
No. Good news is with divorce, as long as we have a decree, no need to be credit qualifying. We can do a non-credit qualifying and remove the spouse. Even though we may have used spouse's income to qualify, it doesn't matter. VA allows us to remove a borrower in the event of death or divorce without credit qualifying.
Oh, perfect. That is really great. Thank you. Mm-hmm. Let's see here. Let's see if we've got any other questions coming in. Oh, we've got Darren Ogino ringing in saying, great job, Kelly. I agree. Second that. Go ahead, everyone. Bring in your questions for Kelly. Kelly, do you want to put your contact information back on while we continue to talk so that they can jot that down and have that handy?
I will. And I'll mention, I know this is all stuff that most of you guys know, but kind of like Judy said about riding a bike, it's interesting how much, even me, who I've probably done more IRRRLs than it feels like any human standing. I know it's an exaggeration, but I've done a lot. Forget. And I'll mention this too, and you guys have probably all experienced this in various different ways, but I keep having brokers, loan officers kind of, but ChatGPT told me I didn't have to reduce the interest rate by 2% going from an ARM to a fix, or a fix to an ARM, I'm sorry. And so a lot of these things, let's say ChatGPT is reading the handbook and giving you that information. Well, that information is actually in a circular that was published by VA that Chat isn't reading. So most of you know this, it's just a refresher. And then you see something, you're like, and Chat's very, very convincing when they tell you that it's not needed. So reach out to me anytime. I can answer questions. It's always good to have a refresher, and just know that there's nuances, obviously. So if you have any questions, just let me know.
Absolutely. And that's a really great point, because of course now we have a lot of borrowers that come to us, right, with ChatGPT verbiage and say, why are you requiring this, or why are you doing that? ChatGPT says this. We around here at our office, we like to kind of refer to it kind of like DU, right? It is, or DO. It is, junk in, junk out. It's how you ask it, how you prompt it that gives you certain results. And it is privy to certain information, but not all of it. And it still gets things wrong. So the reality of it is ChatGPT, I believe, is about, I watched a documentary, it's about 7 years old right now. So, so we're dealing with a 7-year-old, and he's got a lot to learn. Definitely as a, artificial intelligence, he can learn a lot in 7 years, or she. They can learn a lot in 7 years, but there's definitely a lot to learn. And this is one of those spaces, the true guideline digestion, the deep dive with guideline digestion and understanding, and then that human experience by what we've seen that works in the past, how to get exceptions, how to get around certain things, and how to implement the guideline in a way that AI cannot even start to understand or comprehend. So definitely, regardless of what AI says or what chat says, Kelly Dunbar at Freedom Mortgage is your expert when it comes to understanding the guidelines, how to apply them properly, and how to handle special situations that are not in the handbook, that only experience can speak to.
So true. We actually have an internal, it's great. It's an amazing tool, but it's an internal AI for guidelines. But I can't tell you how often I find errors in it, or you didn't ask it the exact right way. And so it's like it can lead you to 80% of the answer, but then the other 20% you need to know from experience and knowledge and whatnot.
Exactly, 100%. Well, it looks like we don't have any more questions coming in. Would you like to continue sharing on any topics, Kelly?
Honestly, it's such an interesting market. And I do feel like I only get to see a corner of it in my little world, because I'm government agency only, and there's this giant world of non-QM and bank statement loans and DSCR. So in my corner of the world, honestly, the biggest changes are ARMs right now. I will tell you, and I should have mentioned this earlier, I think a big part of Freedom Mortgage's success over the years and becoming as big as they have has been our owner stand middleman predicting the market. And honestly, the guy blows me away. His gift for it is unparalleled. I remember the very first time I saw him spoke, I'd been employed for like 11 days, and he made these wild conjectures, and every last one of them came true. And every time he does it, there's these wild things, and every last time it comes true, and it blows my mind. And I think that's why he can just see around corners, and he kind of knows what's coming, and he plans for it. And why I mention that is we are starting to hire. So we are starting to bulk up the ops team. We're hiring people. We're in training right now, because he believes that we're going to start seeing that volume soon. So he's getting ready for IRRRLs to pick up, which is why I presented on it now, not just because it's a fun, easy topic, but because we do anticipate them coming. So it's a good time to brush up before you're inundated and before you can do anything else. Take a look at your book of business. I'll tell you guys, everybody has been dry for a while. So people are going to be after your clients. Make sure you get in front of them first. Have a conversation with them about their target rate. Be ready to strike. Tell them, not to wait for the next lower rate. Just strike when it's there, because if the market stays anything like it did last time, maybe they'll be able to IRRRL a second or third time. If they're so convinced, rates will drop farther. But take advantage of the opportunity now, especially because, like I said, there's just between servicers, more independent mortgage bankers, other brokers, there are a lot of people looking for that business. So stay connected to your clients. Let them know that every single solicitation or piece of mail they get is just a reminder to call you, because you have more access to more lenders with better rates than anybody else. So you're the wealth of knowledge, you're their trusted advisor. Now is the time to start having those conversations, because we really do believe it's around the corner.
Absolutely, 100%. I love that you said that, because that's definitely something that needs to happen at everyone's desk. And knowing their client's appetite, having that list ready, calling on them often and staying connected is such a great strategy. I know that we talked about VA IRRRLs today, and since we've got a little bit extra time, let's talk a little bit about FHA IRRRLs and some of the differences there. One of the biggest benefits for VA IRRRLs obviously is as long as you're meeting the recoupment period, that you can roll the closing costs in, whereas it's a little bit different on the FHA side when you're performing an IRRRL, and some of the things to look out for and having to bring some of those closing costs in. Do you want to talk about that?
Yeah, it's funny. When you said it, the very first thing that popped into my head is the major difference, especially in our market, because we're so used to doing VA IRRRLs, and we haven't previously had a really large FHA streamline market because we haven't done a ton of FHA business in Hawaii. And you can see the numbers from HUD. Historically, Hawaii is one of the lowest per capita FHA producers in the nation. But that's starting to change, and we're starting to see more FHA business, which means we will start to see more FHA streamlines, and we do want to be prepared for that, especially when we're so accustomed to VA IRRRLs, and there are differences there, and most notably, the one that catches everybody up is the closing cost and how you handle that differently between a VA IRRRL and an FHA streamline. And with a VA IRRRL, you can roll all those closing costs into the loan and you're good to go. With a streamline, you cannot. There is an exact calculation of your max loan amount, and you cannot, closing costs either must be paid by over par pricing or by the borrower and brought into closing. So that's a really important when you're looking at a strike rate for a FHA streamline. You're going to have to be more conservative and you're going to have to pinpoint that strike rate a little more carefully than you do an FH or a VA, because the VA you're a little more loosey-goosey. You got a little more room to kind of make sure that the borrower can close that effectively and with good benefit to the borrower. The streamline is a little bit more, and it probably is worth. I don't know if any of you guys saw it, but I did a series of like 10 tips to know if you're a VA loan originator. I'm actually working on the same series, 10 tips for FHA loans, which I'll be sending out relatively shortly. I think I've got 7 or 8 of them filmed. I like to do it when it's 10 so I can stay organized and not stressed out. But I will include some information about FHA streamlines on that, and worksheets. And if you ever have any questions, again, reach out to me. But that probably does deserve its own presentation at some point.
Absolutely. And I'm just really happy that, rebate pricing is coming back so that we can accomplish some of these things.
Exactly right.
And one of the things for FHA, so we've got a couple of comments coming in here. We've got Karen Klein. Thank you. Kelly Dunbar singing your praises. And then Darren Ogino chiming in about FHA. That's because they don't increase the max loan amount for Honolulu County.
I know. I agree.
Yep. As a precursor to what we are working on here at HAMB. So as you all know, in addition to our education committee and our technology committee and our community events committee and our conference committee and all of the other committees that we have, one of the committees that we have is our legislative committees, which took on a huge undertaking when we brought the message about our condominium sublimit challenges that were being faced here, how it was affecting our homeowners and our families here locally. And with that support from Washington, D.C., we were able to bend the ear of the mayor and get some of that legislation put in place so that we do see many of the buildings starting to have relief. We were able to work with DPP in order to get a fast track put in place for those buildings to get their permits so that they could get their repairs and get their insurance. And we have been working with HUD to explore Section 214. So for those of you that always stare at that HUD,
Mhm.
circular that talks about the loan limits and what they are in, every county, including Hawaii County, Honolulu County, and you're looking at that number, and right underneath that box where they talk about section 214, where HUD does have the ability in order to increase those loan amounts. We are working directly with HUD. In fact, myself and Lisa Kathy Kirkbride, who is also our co-chair for education, she and I had gone down to the HUD office to start that conversation with them. We've got some email threads going now, and our intention is, again, to go to Washington, D.C. in April, talk to our representatives and our senators about this need and see if we can't bend HUD's ear and put in place the protocol in order to get to these larger loan amounts. I know that, Kelly, you and I have talked about it. You brought it to your heads here at PRG. I've brought it to my heads. So together, I think collectively as the forefront lenders here trying to get to that access to that section 214, I think it's going to be a good year for us to move through that. Darren is also chiming in. Can you ask HUD to make the FHA condo process easier? Well, getting the whole building approved, getting the whole building approved can still be a challenge.
Oh, that's
but
true.
Remember, spot approvals are back, Darren. So
right.
you realize that, spot approvals are back, and they're not looking at sublimit insurance. So that's been giving us a big lift here in our office as well. Good fun. Okay, so FHA, IRRRLs, having to bring in the closing costs, watching out for that. Have you seen any success with that, Kelly, as far as the rebate pricing being enough in order to kind of digest that and handle that? And what is kind of those interest rates or circumstances that make it possible that you've seen?
Honestly, we do a fair amount of FHA streamline business every single month. So there are borrowers out there, absolutely, that can take advantage of it. And it varies, ultimately, because an FHA streamline also has to drop the rate by 5%. So again, whatever rate the borrower is currently at, the half point rate or lower, that's their strike rate, but that has to have enough rebate to cover closing costs, or the borrower has to agree to bring in those closing costs to the table, which, is certainly possible depending on the borrower, because generally speaking, they're going to skip a mortgage payment or two, depending on when and how you close it. So I don't think it's unreasonable to expect a borrower to be able to bring in funds to close on an FHA streamline. Now, obviously, do we all prefer to sell a no closing costs, skip a payment streamline? Of course. But again, if you have the ability to drop your borrower's interest rate by a half in a streamline process, it's certainly worth looking at both angles, both bringing in funds and not bringing in funds. And sometimes the borrower just can't do it. And so be it. That's certainly reasonable. I think it happens to many, many borrowers. That's not unreasonable. But it's worth having that conversation with the borrower, because then you know exactly where your strike rate is. Do you have to have a rebate at that 0.5% lower, or can you do it right at par and get it done? And so I feel like that's a big part of the conversation with an FHA borrower versus an IRRRL borrower. And I will mention one thing, we were talking about advocating for the Section 214, which has been a big part of our year at HAMB this year. And so hopefully we get some traction on that. I think it does help that we've been able to increase our percentage of FHA business and transactions that we're doing. For so long, we did so little. And Darren, you're exactly right. It was because the loan limits were so low. But it was really those SUAs that gave us the opportunity, because let's face it, at the current FHA loan limits, you're not buying a single family residence, at least on Oahu. So you're only buying a condo. Well, there were no approved projects. So now that we have the studios, we're able to close a lot more. And so we're starting to see that business, and HUD is seeing us as a viable market. And now it makes sense to have those Section 214 conversations, where before it was like, why? Why would we they're not doing the business anyway. We are doing the business. There's need for the business. And so that makes those conversations much more reasonable.
Absolutely. And then in regards to the VA IRRRLs and the FHA IRRRLs, so I heard you mention that for VA IRRRLs, going borrower paid is going to give you your best lift.
Not necessarily with 30-year fixed. The 30-year fixed still has enough movement in the margins and in the rebate pricing that you certainly can. We all know that oftentimes when borrower paid is the best benefit to the borrower, but we also understand that you need to make money and so on and so forth. But when you're going ARMs, in order the true benefit of an ARM is getting the lowest rate possible, right? Well, there's such little difference in pricing in each 1/8 quarter of a rate that you'll get so much more bang for your buck going borrower paid on an ARM than on a fixed, just because there isn't as much spread in the pricing.
Perfect. And then for FHA IRRRL, you would almost want to do the opposite, because you need to build in your comp so that isn't hitting the borrower, and then trying to price it at a yield spread so that you can cover some of those closing costs to minimize what they may need to bring in, if anything at all.
Exactly.
Yep. Very good. Any other items that you'd like to, in closing, would you like to leave with our audience today?
I don't think so. I think I just would like to thank HAMB for hosting these, organizing these, for continuing to build community in our market. You know, the best part of what we do is working with each other, working with our borrowers, being able to truly help people and put them in a better position, and being able to foster a community that does that together. I'm so appreciative of HAMB and everything that you do, both in the community at large and our smaller little mortgage broker community. Thank you for having me. Thank you for allowing me to be part of it. I'm honored to be on the board this year. I just was talking with Judy about it going into next year. I'm thrilled. I love being a part of it, and thank you for having me.
Well, we truly appreciate your service, Kelly, you know, being on our committees and really helping us push all of these things into the community is really, really where it's at. So it's your hard work and your elbow grease that helps us get there. And of course, Freedom sponsorship that helps to fund these educational webinars, as well as all of our other events. So thank you so much for everything that you do for us here at HAMB.
Thank you so much. And hopefully everyone here will be at Pauhana tomorrow night in Naha. It's always good. It is a beautiful location. Absolutely. And delicious food, homemade food this time.
Yes, and taco night. So, all right, everybody. Well, thank you so much for joining us today. Thank you, Kelly Dunbar, Freedom Mortgage, for all of your expertise. Please reach out to Kelly for all things VA, FHA. She's here to answer all of your questions, and obviously a wealth of knowledge, and help you to get around those guidelines and win those deals. And of course, great, amazing pricing. See everyone tomorrow at the Pauhana at Naha. And it starts at 5:30. Check-in will begin at 5 o'clock. And let's get out there, have an educational time with the lender roundtable, and eat some great taco food and have some drinks together and share together. Thank you, everybody.
Thanks, guys.